Everyone, stick with us versus her. Today we're going to cover if this is a V-shaped recovery in the market. A lot of people are coming out the woodwork. We're having, back-to-back green days here. We're above the 10-day moving average. And so we're going to go over some charts, kind of discuss, what the situation is here, especially like if you started trading within the last 5 years. I mean, V-shaped recovery is all you know. You just throw money at it. And a lot of retail traders are just throwing money at it, right? And I'm going to kind of give you my opinion on what I think and show you, the chart and what it's telling me and like what to look out for. But first, if you want to get connected, link is below in the description to our Discord and our options trading group on Facebook. And if you want to text me, number is below, so shoot me a text. We'd like to hear from you. Let me know. But let's get into some of these charts here, right? So getting into currently what's happening now, we had a massive rally today. The Fed speakers were just kind of shaking us out in the morning, and then we went straight vertical. I mean, Dow was up over 400, Nasdaq was up over 300, almost 3% here on the Nasdaq. S&P's way up, almost 100 pointer on the S&P's. I mean, just crazy, and everyone's getting real excited. Now, just keep in mind right here is we are still below the 50-day moving average. We're still below the 100-day moving average. We're still below the 200-day moving average, right? Now, we are above the 10-day moving average, and I've been talking about this for quite a bit, where every time it was hitting the 10-day, it kept getting rejected. Now, it seems like we started to have a change of trend here this was May 27th. I mean, we're only a few days ahead. Now is June 2nd, so we're not like, I wouldn't say winning the war. But the biggest thing that came out today is Microsoft lowers their guidance. They're saying that they're basically not gonna make much money. They blamed it on foreign exchange rates. I mean, it's just crazy. It says in an investor slide deck, Microsoft said it expects to report between 51.94 billion and 52.74 in revenue for the quarter. The company's previously forecast fourth quarter at 52.4 and 53.2. So it cut its earning forecast for the quarter, and basically, to have one of the biggest companies in the world, not just in America, but in the world, cut earnings forecast is, not good. Not good. And, we went over this yesterday where, a lot of companies right now are not hiring. There's a hiring freeze. Currently, there hasn't been like a ton of layoffs, or has been layoffs, but not a ton. But so far, to crush inflation, the Fed needs to slow down the economy. And if you're kind of looking at all these things, and you're looking at Walmart, you're looking at Target, you're looking at Amazon, and now you're having, Microsoft lower its guidance. I mean, I would say what the Fed is doing is actually starting to work, because to lower demand in the economy, the Fed actually has to crush demand to crush inflation. And I know we don't like to hear that, because if you crush demand, I mean, then the flip side of that is the companies make less money, they report less, and then they start layoffs, right? So it's not good. It's not good. But kind of going back into here, personally, I think, we're kind of having a bear market rally, right? Where if you take a look back in here, same exact thing happened. Let me pull this back a little bit. Didn't mean to do that. If you look right in where we were right in here, we had a pretty major sell-off, and then we rallied for 2-3 weeks here, and this is back in March, right? And everyone's like, you had Jim Cramer come out and be like, yo, I hope you bought the dip, blah blah blah, and then he got obliterated in PayPal, and all the big funds got obliterated in PayPal afterwards. But I mean, what I'm looking at here is, I mean, this is super important. And the biggest thing is here, if we take a look here, take a look at these areas right in here. The Nasdaq was rejected at the 200-day. This purple line right here is a 200-day moving average. It was rejected once, big, twice big, and then for the third time, this is the last time it actually came up here, which is back in end of March, early April. It just got obliterated. We could not get above the 200-day moving average. So until we get above the 200-day moving average, like I really don't want to hear it. Like I don't want to hear that we're having a V-shaped recovery. Sure, we're going to have up days. We're going to have hopefully have green weeks. But right now we are in a massive downtrend. But let's kind of go back. You know, if you're accustomed over the last, and we'll look at the S&P too, but if you've been trading over the last 5 years, this is the last 5-year chart here, and we can go into 2018, right? 2018, this is what you would expect. You know, this was the end of the year, 2018. The market was up on the year. Then the tariff war came on, and the whole thing with China and Trump and that whole thing. You know, basically we ended the year down, and then as soon as January hit, we were just ripping every single day. We were just going way up, right? And you know, I think in terms of retail traders and investment strategy, the only investment strategy that people had to know was to buy the dip. That was the only strategy that they had to do, and it worked. And then they got into 2022 where they keep buying the dip, and then finally they're like, I don't understand how this dip keeps dipping. This strategy worked for years. It worked for years, and this is 100%. It's 100% true, right? You know, your strategy has to adapt. I mean, same with COVID. Let's go back to the pandemic, right? Pandemic was, the market crashed. We cratered hard. We went down fast. I mean, there was multiple limit downs, and we went down hard, but we came right back up. The only difference I would say that 2020 and 2022 is that during this time, the Fed was lowering interest rates and just printing, pumping money, and just that balance sheet soared because they wanted to stabilize the economy. They wanted to stabilize the markets. And, you know, we saw stocks go from like Penn and ARK go from penny stocks to be worth 100, 150. I mean, we saw Peloton. I mean, you guys were there for the most part. We don't need to go over it. And the main difference is right now between 2020 and 2022 is the Fed was easing and they were doing anything they could to support the market. But the flip side now, the Fed is tightening and doing anything they can to crush inflation and not support the market. So if they're trying to crush inflation at all costs, and you know, they don't care about the stock market. They don't care about Microsoft or Amazon or Walmart. They care about lowering inflation and lowering the prices, and, you know, hopefully trying to lower the gas prices, energy prices. I mean, since 2020, this whole world's been out of whack, where, as you can kind of see, I did say this when I was live streaming and talking about it in 2020. You can kind of go back and see what we were talking about back then. But I said, hey, anything that happens now, what the Fed does, we're going to have repercussions. We're going to pay for it one day. You keep putting Band-Aids on it, Band-Aids on it, Band-Aids on it. And then one day, we got to pay. We're going to have to, the market's going to take what it owes. You know, it's going to come due, right? So, you know, looking at it now, I mean, we went straight up, and was sure we had some time here. We dipped, rallied, but overall, I mean, we really haven't had anything bad happen to the market since March of 2020. Pretty much just been straight up. I mean, we had some massive rallies, but the Fed has been supporting this the whole time. And we kind of line this up with the Fed balance sheet. If we line this up with the Fed balance sheet, I mean, kind of look at, you know, the situation here. I mean, this was 2019, right? 2018, 2019, and then we just had massive stimulus, but they didn't stop in 2020. They kept going all the way through 2021, and here we are, 2021. I mean, all of this, I mean, I think it was Fed-induced. They were printing trillions, which they gave a lot of money out to a lot of people that didn't need it, and they put it into the market. And then we had this whole like euphoria, and I don't even think I've ever seen anything like the meme mania or whatever they brand it these days. You know, I've never seen anything like it. But for me to start saying like, hey, we're gonna have a V-shaped recovery, right? We're gonna have a V-shaped recovery. We have to get above the 200-day moving average. I mean, the same thing here for any stock you're looking at. The S&P here, same exact thing, still below the 200-day moving average. It's purple line, 200-day moving average. So if your strategy was like, let's buy the dip, mean, it's just not gonna happen right now while we're in a massive downtrend. Sure, you can make money on the bear market rallies if you want to call them that, but I mean, you got to change. If you want to have longevity in this market, you have to change your strategy. You can't just be doing the same thing. If that is the case, then we wouldn't have to do anything, and we would just all be millionaires, but billionaires. We wouldn't have to do anything. But we're constantly as traders, having to adjust strategy. Now, if you're an investor, I mean, you might be looking at some of these things and buying some stocks, buying some Apple stuff, and you got a multi-year time frame for it to play out. That's cool, right? That's fine. But as a trader, like, we have to make decisions, and buying the dip is not what's going to happen, right? It's not going to be sustainable, and we're on month 6 now of this downtrend, and we're going to have up days, we're going to have everything in between. We really haven't, one thing that we haven't has really like flat days. So let me know what your thoughts are. Leave a comment below. Let me know if you watched the end. As always, stay safe, stay green. It's us versus herd.